Hello, everybody. How are you? How's everything going? All right, sorry for the 2-minute delay. All right, so today we want to talk about a topic that we hear about in the news every time Trump goes to talk about his tax plan. He mentioned TCJA, and we don't know what's TCJA, or maybe we know, maybe we have an idea of what is that, and we want to focus on, or we want to explore more, like why is it a big deal? Like, what is he talking about? What are we trying to understand from the extension of it or the expiration of it? And how, like, what is really the plan? So, let's dive in, let's start, and we'll talk about it in more detail. When I was looking for the for like the joke that because I always like to talk about a joke, to start with the joke, so that this is the first one that I found related to Trump. It's old, but it's still related. All right, so Trump keeps saying Congress needs to pass tax cuts for everybody. This is what TCJA, Tax Cuts and Jobs Act. He keeps saying we need to pass the tax cuts for everybody. So what does that mean? First of all, let's talk about pre TCJ. What in 2017 and prior, what was going on and what happened when he changed the law or he passed the TCJ law, and what are we doing after? Or what was the expectation if it expires? So let's start with the pre TCJ. First thing is the individual tax rates. We had seven tax brackets ranging from 10% the lowest to 39.6% the highest. And the highest tax bracket would apply to taxable income over 418,400 for single filers and 470,700 for married filing jointly. All right. And this is like how it would look like. It would look like something like that. So if you see the tax rate, and this is a single filers up to this amount, and married filing jointly, and you see like if you are but these numbers are adjusted for 2025 inflation. And I'll tell you why I adjusted it for that. So in 2017, it was a little different. But just to give you an idea of the tax brackets, and if we adjust that for this year inflation, this is how it would look like. And I'll tell you why I adjusted in a minute. All right, so this is the individual tax rates. There was also something else, the standard deduction. As you know, we have a standard deduction and we have itemized deduction. The standard deduction was lower than it is post the law. It was 6,350 for single filers, 12,700 for married filing jointly. So it was low. Personal exemption. There was something called personal exemption. You probably don't hear about it now because it is no longer there. Personal exemptions were allowed. There was like 4,050 per person, which could be claimed for the taxpayer, the spouse, and dependents. So you multiply this number by the number of people on the tax return: taxpayer, spouse, and dependents. Personal exemption. And then as far as itemized deduction, medical expenses over 10% of your adjusted gross income were deductible. State and local tax deductions were allowed with no cap. So this, any taxes you pay on your property, on your income for the state, like if you live in a state that has taxes, like in New York or some other state, you pay taxes on to the state. So that used to be deductible with no cap and goes under your itemized deduction. And mortgage interest deductions were limited to interest on loans of up to 1 million. So if the loan is more than 1 million, there would be limitation. But if it's less than that, then there's no limitation. So that's for medical expense, state and local tax, and mortgage interest. And as you know, because people would usually pick which one to use, itemized deduction or standard deduction. The standard deduction was very low, as we said. That's why a lot of people were taking the itemized deduction. So let's see, how did this change after? Post TCJA, 2018 till 2025. So when you're filing your tax return for 2024 and when you file your taxes for next year, for this year, 2025, next year, this is what's gonna apply. Individual tax rates the brackets are 7 brackets ranging from 10% to 37. So what it used to be, the highest thing used to be 39.6, now it is 37. This is the highest. And the highest rate of 30%, 37% applies to the taxable income over 518,400 for single filers and 622 for married filing jointly. So the numbers changed way higher than it was. So this is, I'm bringing again the pre-TCJA tax brackets that we talked about, adjusted for 2025 inflation. So I'm not going back to what it used to be in 2017. I'm adjusting because every year it's being adjusted for inflation anyway. Every year these brackets keep increasing. So we're assuming, let's say if we go back to what it used to be, if the TCJA expired and we go back, so this is what's going to look like. If let's say you have like you're a single filer, you have an income of 50K. So what tax brackets you would fall under? 25%, right? If you're 120K, what tax brackets you would fall under? 28%. If you're 500K, what is the tax bracket you fall under? 39.6%. But post TCJA, the numbers changed. Now if you're 500K, you're not 39.6, you're not 37, you fall here under 35%. You see the difference? Okay, we said 50. I'm going back and forth. Just focus on the title here. Let's say 50K. We said how much, what tax bracket you would fall under? 25% here under the old rules. 50K would be under 25%. After TCJA, 50K would be under 22%. So you see the difference? If TCJA expired, we are going to be using this. We're going to be using the pre-TCJA adjusted for the inflation only, but we'll go back to the higher tax rate. The 39.6% is going to be back for over 448,000. All right. So that's just to give you an idea. But if it extended, we continue to be with this schedule and with these lower tax brackets. All right. Okay, so this is as far as the individual tax rates or the tax brackets. What else? As far as standard deduction, post TCJA, standard deductions are no longer low, they are nearly doubled. So we see for single filers, it's at 12,000, and it started with that in 2018, and then it kept increasing for inflation until it's going to be 13,850 in 2025, and it is always a double for married filing jointly. All right, so it's 12,000 became 24,000. So with the increase in the standard deduction, what do you think happened? A lot of people are not itemizing deductions anymore. And I think that was the idea, that we don't want people to go over like going through a lot of like digging into their itemized deduction. Maybe we make the standard deduction higher and they don't have to worry about itemizing deductions at all. So a lot of people now are using the standard deductions because it's high. All right, so what happened to the personal exemption that we talked about, the 4,050? It's gone. It's no longer there. It was eliminated. And I think nothing was talked about that it may come back. I think the intention is to keep it eliminated. All right. Itemized deduction. Itemized deduction, what happened to it? The threshold for medical expenses deduction, it reduced, we said it was over 10% of AGI. Now it is 7.5% of AGI. So is this a good or a bad thing for taxes? It's good because now you have more medical expenses that you can qualify as a deduction. You don't have to go with the high threshold. You're going with a lower threshold. That's why a lot of people are able to deduct some of other medical expenses. It's still high, so it depends on what's your income. But this lower percentage allowed more people to deduct more of medical expenses. All right. As far as SALT, the state and local tax deduction, they were capped at $10,000 for both property, income, sales tax, all state taxes combined. So this something that was good or bad? It was bad, right? It hurt a lot of people because especially with the Democratic or the blue states, we have high taxes in the blue states, and that was a big hurt because we pay hundred thousands in state and local tax, but we're only capped at 10K. So that was a hurt in when the TCJA was introduced. All right, what else? Mortgage interest. Mortgage interest deductions were limited to the interest on loans of up to 750, down from 1 million. So now the limitations is not if the loan exceeds 1 million, now the limitation starts when the loan exceeds 750. So that was also a bad thing or hurt more people than it used to. But again, they increased the standard deduction to make more people qualified, and they kind of played with the itemized deduction to let people like, we don't want you to use the itemized deduction for a reason or another. But there was a good thing. The AGI limitation for cash contribution to the public charities increased from 50% to 60%. So that was a thing to the taxpayer favor. All right. So there was something else happen. It wasn't only about the individual, it was also about corporate. It was mainly about corporate, or a lot of corporations and a lot of medical business owners were affected by that. How? Because if you're a corporate, if you're a corporation, C Corp, the corporate tax rate was lowered from 35% to a flat 21%. So that was definitely a huge drop that benefited a lot of corporations. And that affected a lot of people like doing conversion from an S Corp to C Corp. And there was also some rules related to that. Like if you want to convert, whether this is going to be a good thing for you or not really, depends. But of course, it's a situation by situation basis. So this is for corporate tax rates. And in order to make it, okay, we don't want to encourage so many conversions from S Corp to C Corp or from other entity structures to C Corp. So they introduced something that was never there before called the qualified business income deduction, which allowed a 20% deduction for qualified pass-through entity like S Corporation, partnerships, LLCs, even single member LLCs. But it has limits and it has certain types of income and depends on the type of activity, whether it's a certified service or not or not. And it has a lot of other rules on its own. But the idea of that you're now allowed a 20% deduction of your net income if you own an S Corp, partnership, LLC, to make up for the reduction of the corporate tax rate to those who don't have a C Corp but have a pass-through entity like those S Corp, partnership, LLC. All right, what else has changed? We're all talking about post TCJA, meaning that if this expired, we go back to the old rules, to the 35%. We go back that there is no 20% QBI, and so on. Child tax credit. The child tax credit increased to $2,000 per qualifying child, up from $1,000, and the income phase-out threshold was raised significantly, so a lot of people were more qualified to claim it, even with with higher income threshold than before. So if expired, what do? We go back to the $1,000, and instead of 2,000, a lot more people would be disqualified because of their income and their income threshold. Before TCJA, high income taxpayer phased the phase out of itemized deduction. That's another thing. Like if not you were not allowed just to take 100% of your itemized deduction. High income taxpayer, they phase out and some limitation of itemized deduction. In some cases, you are not allowed to take it because if it's too high and your income is too high. But after TCJA, there is no this phase out is no longer there. All right. So again, now we're talking that or Trump proposal is to extend the TCJA to keep it the way we are doing it now since 2018 till 2025. And he's proposing some tweaks with the extension. What is he proposing? He's proposing to remove the SALT cap. So he said that there is a 10K cap on the state and local tax. He wants to remove this. He wants to make the blue states happy. So he wants to remove that. So now we can probably go back to deduct all state and local tax without limitations. Going back to 100% bonus depreciation. So for business owners, they know that with TCJA, we had the bonus depreciation. You could take 100%. They started with 100% and it kept going down. It's 60% 2024. It's going to be 40% 2025, 20% and then zero. So it kept going down 20% every year. And now we can go back to 100% bonus depreciation. So if you if people were buying fixed assets and they were taking 100% depreciation on it in year one, or let's say now 60% in 2024, that could go back to 100%. And I think he mentioned in the last Congress talk that he wants to do this retroactively to January 1st, 2025. So may even see a change in how 2025 will be treated. So we're not only talking about it changes after for year 2026 and after, we're talking about changes in the current year where we're having all these discussions. Another thing he proposed that corporate rate can go down to 20% instead of 21%. He wanted to bring it down even further to 20%, or 15% for company manufacturing products in the US. So that's definitely a huge drop in the taxes. So with that, there's a lot of things that we have to look at. How can I plan? Should I run two scenarios with what if the TCJA expires and we go back to the pre-TCJA? Yes, adjusted for inflation, but we're not going to go back to the same exact numbers. Standard deduction is not going to go back to $6,000 because it will be adjusted for inflation. But what am I going to do? Am I going to benefit from standard deductions, or am I going to benefit from itemized deduction? Do I need to pay the state taxes is there a way for me to delay paying the state and local taxes this year and maybe keep it to next year, or should I go ahead and pay it this year? So there is a lot of planning required for this year. 2025 is a crucial year of how we're going to plan, because every decision we're going to make in our business and our even like personal life is going to be affected some way or another with this proposed tax changes. whether it expires or not, there's going to be an effect on it. So we're going to talk more about it. Maybe next week we'll talk more about planning. What can we do? And how can we navigate this uncertainty in tax proposals? And we'll keep an eye on the news and everything to see how it's gonna affect us. All right, please reach out to me. Tell me if you found this helpful, if you need certain topics that you want to talk about. I found this topic to be like interesting to a lot of people, and that's why I wanted to talk about it. But it has a lot of things to talk about. Like, and we already exceed 20 minutes in our presentation. So I'll leave the planning to next week, and see you there. All right. Bye.